Welcome back, everybody. So, one company that's been getting discussed a lot lately is Celsius. They are the makers of a new energy drink that's gained massive popularity in recent years, with their total sales rising by a multiple of 10 from 131 million in 2020 to 1.3 billion by 2023. But their 2024 year has not gone so well. They're down about 50% year to date because sales growth has started to slow down, partly due to them losing market share, but also due to more macro factors like consumers cutting back on spending, which has weighed down the whole category. Back in Q2 of 2022, Celsius's revenue grew by 138% year over year, whereas in Q2 of 2024, they showed 23% revenue growth. So it really seems like the reason the stock is down so much this year isn't because the business has now become a worse business, but really because investor expectations came back down to reality after a few years of very fast growth. Now, the company is fundamentally very strong. They have essentially zero debt with $900 million in cash. They're a very asset light business, and return on invested capital over the past 12 months is north of 25%. And they're currently trading at a PE of around 30x. So, for a company that is growing this fast and has such strong fundamentals, this seems like a pretty good deal at the surface. Now, I think one of the reasons there was so much investor optimism surrounding this specific company was because of the past success of Monster Energy, which is a company that is famous for being one of the best stocks you could have ever invested in, delivering a total return that is north of 19,000% over the past 20 years. And the situation Monster Energy was in back in the early 2000s is eerily similar to what Celsius is in right now. So in this video, I want to talk about Celsius from a more long-term view and try and understand where exactly the energy drink market is heading and understand just how strong the Celsius brand actually is. Because although the fundamentals appear quite good right now, Celsius's success is a very recent phenomenon, and this could just be a trend that dies out in a few years' time. So without further ado, let's just dive right in. So Celsius's real claim to fame for its customers has been that it was a more health-conscious alternative to traditional energy drinks, which typically had high amounts of sugar. And this branding resonated with younger generations like millennials and Gen Z, who are known to prioritize healthy lifestyles. Now, for a long time, this company was publicly traded. It actually IPO'd back in 2007, but the company was small for a long time, although its revenue was still growing. Even if we look at 2015 revenue, which was $17 million, they still grew to about 130 million by the year 2020, mainly due to them expanding their points of distribution such as gyms and retail stores, and also building out an e-commerce presence through Amazon, which really started to take off in 2020. Now, the biggest trend that's been occurring in the energy drink market has been this shift towards healthy alternatives, which has been a huge driver for Celsius over the years. And the energy drink market overall is expected to grow at about 8% annually until the year 2030. But the real break came in 2022 when they signed a partnership deal with Pepsi, which allowed Celsius to leverage their vast distribution network, especially in locations like gas stations and convenience stores, which for the energy drink market is significant because roughly 62% of sales occur in convenience stores specifically. They also invested heavily into things like influencer marketing and signed deals with sports leagues like the MLS. So this allowed them to get in front of customers more frequently and build up some brand value. And they've also been expanding internationally a lot more recently, which does represent a big opportunity for them since only 5% of their sales come from outside the US, whereas a comparable company like Monster has 40%. Now, this international expansion will be a gradual process because their strategy for expanding into a new market is to start with targeting fitness related channels, so like gyms or supplement stores, because they still want to be seen as a health first company. And then they start working with a few key suppliers. So, for example, when they expanded into the UK, they partnered with Tesco, which is a big grocery chain in the UK. And the reason they do this is because if they try to distribute across too many retail chains too quickly in a new market, they risk not being able to generate enough consumer demand, otherwise known as pull through, to maintain shelf space in all of those locations. So retailers will often assess product sales performance, and if items aren't selling well, then they will remove them. So it does take time to build demand in these international markets before the sales actually start to materialize. And so, because of their recent growth, they've gone from 3.6% market share in the US to 11.5% as of the most recent quarter, and took share away from the two biggest companies, which are Red Bull and Monster. Now, the company first became cash flow positive in 2022, where they generated $90 million in free cash flow and then $124 million in the following year, and they've been consistently net income positive since the beginning of 2023. So for a while, things were going very well for Celsius. Their market share was expanding rapidly. They were developing a loyal customer base, but so far in 2024, they're down around 50%. And there's a few reasons why. For starters, in a recent conference call, the CEO mentioned that Pepsi is reducing their orders by $100 million down to $120 million for Q3 of this year, which investors interpreted as weakness in demand for the product. Now, there is a bit of a disconnect between when Celsius recognizes revenue and when they actually sell their products to consumers. So, Celsius management was trying to make the case that this is a more of a temporary thing and doesn't really mean anything long term. But investors aren't buying it, and rightfully so, because if the demand for this product was there and it was flying off the shelves, then Pepsi wouldn't be doing this. What's more likely is Pepsi overstated how much demand was actually there for this product, and now they need to cut back on their inventory levels because they bought too much previously. Now, this doesn't mean that Celsius is now suddenly a bad company. It just means we have to revise our expectations a little bit because they're still rapidly expanding their points of distribution in convenience stores, especially. Sales on Amazon are still growing fast. They mentioned this was 41% growth year over year. So it's not like sales have just suddenly fallen off a cliff, and the demand is still quite strong. However, another reason was how they've recently been losing some market share to Red Bull. And the story with Celsius before was that they're quickly taking market share and disrupting the space. But now this trend has started to reverse, and investors don't know if this will keep happening or if this is just a blip. And I think this really highlights the biggest risk investing in a company like this, which is that it really has no defensible advantage over the competition. You could argue that they have brand loyalty, which enables them to command a premium price, but if this were true, we would see it in their gross margins. Currently, their gross margins are comparable to Monster, 52% versus 53% over the past 12 months, but also consider that Monster has significantly more scale, with 7 billion in revenue versus Celsius with 1.4 billion over the last 12 months. So as Celsius continues to grow, they can reduce their per unit production costs and raise their gross margin. So I do think eventually they will have better gross margins than Monster, something around the high 50 to potentially 60% range. And this is really what the whole point of brand loyalty is for a company. It's the ability to command above average margins. But you also have to consider that the company really only got popular 2 years ago, so this could be fleeting. And if Red Bull or Monster were to develop an alternative to Celsius, which they probably will, this could lead to them losing market share. Now, the counterpoint to that would be, well, you could have said the same thing about Monster back in 2005, 2006, when they just started to grow really fast, that someone like Coca-Cola could just make an alternative that's just as good and wipe them out. So I think the real lesson here is that brand power is real. Consumers don't always want to buy the cheapest product. They want to buy something that aligns with their lifestyles, and marketing plays a big role in that. And Celsius seems to be tapping in this healthy living trend in a way that no other energy drink has been able to. Now, that being said, there is a lot of risk with a company like this because its success relies on consumers choosing to favor them, and consumer tastes are notoriously difficult to predict. That's part of the reason why Monster Energy's success has been such a shock. There's been hundreds of energy drink companies founded over the years, but none of them have caught on the same way that Monster Energy did. But now, the Celsius brand seems to have something to it. And we can see that this is true in the market share data for the energy drink market and just how fast Celsius achieved such a high market share. This market was largely dominated by Red Bull and Monster, but Celsius successfully carved out a roughly 12% market share in a very short period of time, and their share is especially high in younger demographics like the 18 to 24 demographic. So the last thing I want to show you is how I personally would value this company. And I will say that this is probably not a company I would personally invest in just because this is a very consumer oriented product. And I'd be lying to myself if I said that I could predict consumer trends any better than the average person. And I think as investors, it's very important to be aware of what you can't predict and not delude yourself into thinking that you know something that you actually don't. What I'd say is anyone who is invested in this company is really just betting on the brand value of Celsius continuing to grow into the future. But as investors, how can we deal with such uncertainty? Well, what we can do is come up with a few different scenarios that are reasonable for Celsius and see if their current valuation makes sense under those scenarios. So, for the first scenario, which we'll call the more pessimistic one, we'll assume that revenue grows 20% next year and then 10% per year for the next 5 years. So, we're essentially assuming that they grow at the same rate as the overall energy drink market growth rate, plus a few extra percentage points to account for things like international expansion. And we'll also assume that gross margins expand slightly each year as they continue to scale up, and then we'll assume an exit multiple of 15. Under these assumptions, we get an intrinsic value per share of $31, so slightly below the current price of $35. And by the way, this is using a 12.5% discount rate. But for a more optimistic scenario, let's assume that revenue grows 20% next year and then 20% annually for the next 5 years as well, with the gross margins being the exact same as they were in our other scenario, expanding slightly each year, but then a better exit multiple of 20x. This gives us an intrinsic value per share of $63. So, what this tells me is that the company is likely at the lower end of the range of what makes sense for them in terms of their valuation. And their fair value is probably somewhere between $30 and $60 per share, depending on how optimistically you view their ability to continue to win market share, because that will need to happen in order for them to reach the higher levels and grow revenue 20% per year and be a solid investment at this current price. And remember from before, in the more recent quarters, they were actually starting to lose market share. So this would assume that there is a reversal of this trend, which kind of explains why the stock is now valued at around the mid 30s range versus not too long ago, it was valued even as high as $90 per share. And by the way, if you'd like to access the Excel file that I'm showing on screen here, feel free to join my Discord server where I've posted it. The link to that is in the description. But anyways, guys, that does it for this video. So I hope you did enjoy it, and please leave a like if you did. And if you're new to my channel, I'd appreciate it if you would consider subscribing, and I'll see you guys in the next video.